Hi, I'm Nicole. I'm here at the law offices of Scarinci Hollenbeck in Lyndhurst, New Jersey. I came here to get some answers about a very important political figure, presidential candidate Mitt Romney. But I'm not here to discuss politics. Actually, I'm here because I have some questions about his recently released tax returns and whether I can benefit from the same tax planning that Mr. Romney uses. I'm speaking with Scarinci Hollenbeck partners Frank Brunetti and James McDonough. Frank is the chair of the firm's Tax, Trusts, and Estate Group, as well as a seasoned professor of taxation and law at Fairleigh Dickinson University. James, or may I call you Jim, McDonough, is also an attorney in the tax department, as well as the lead editor for the firm's Tax, Trust, and Estate blog. Welcome, gentlemen, and thank you so much for sitting with me.
Thank you.
So I was recently reading your blog posts, and I had a few questions. Okay, so first, what do I need to understand in order to appreciate the Romney strategies for wealth building?
Well, I think the first thing that is important to note is that it's not just the Romney strategies for wealth building. It could be adopted by many taxpayers because they can apply whether you have a small amount of wealth or significant wealth. So that's one point, that it's not just limited to Mr. Romney. Secondly, an important point is that you have to understand how property can be dealt with in different ways. For example, if you have property that is readily valued, such as stock, real estate, etc., certain strategies work better than others. If you had partnership interests or closely held stock, which are hard to value, then other strategies might work as well.
One of the things that people don't realize is that if something is freely transferable or tradable on the securities market, you can go, for example, and get the price of IBM at the close of business. But what would you get where would you go to price a partnership interest where it's not publicly traded? There, you're not going to pay 100 cents on the dollar for the interest. Instead, you're going to take into account that you can't liquidate your investment, you cannot trade it to someone else, you can't get cash out of it, you can't go to the bank and mortgage it. So those things tend to depress value. And when Frank was speaking about the different ways in which we hold assets, those give rise to what are called discounts. So in essence, you can wind up transferring more property for using less gift tax value. So that's probably the first place where we start with most of our clients. And since most of them own their assets, such as real estate, in partnership form or limited liability company form, it just simply flows from there.
So what assets are best suited for wealth transfer?
All assets. Now, one point that I'd like to make is there's been discussion of when Romney began his wealth planning. And some say somewhere around 1995 was about the time. Now, he was married. He had 5 children. Now, using the annual exclusion, that is the amount of money that one can pass to their children, or anyone for that matter, without utilizing any of your lifetime gift or estate tax exclusion. If you were to make gifts, you and your spouse, to your children, and assuming you had a significant rate of return, and someone like Mr. Romney, who has the opportunity to invest these assets in vehicles that can have a very significant return. Back then it was $10,000 per year. Currently it's $13,000 per year. But let's assume it's $13,000 because that's the information I'm going to use now. And I want to show you the power of making annual gifts. So if the Romneys began making gifts to each of their children of $13,000 per year, which would be 13 times 5 times 2, right, $130,000. And if they were to invest those annual amounts, and since Romney had access to high yield investments, and let's assume an average rate of return of 10%, and let's assume that actuarially the Romneys could live 33 years, how much do you think those annual gifts would yield after 33 years? How much do you think that might be?
I'm not sure, but it sounds like a lot.
It would be over $41 million.
Wow.
So the point I would make is that one point is you start early. You start early with your planning, and you do regular planning. And it doesn't have to be just the Romneys. It could be Nicole It could be Jim. It could be me. It could be anyone that's looking at us and thinking about their estate planning, how they can build their wealth over time. And so time is a critical factor, as we will talk today, in building wealth.
It's incredible.
One of the things the Romneys were very good at is by starting early, they wound up transferring the opportunities that his Bain Capital Investments presented. Certainly not everyone can invest in Bain's partnerships. But the idea being is that they didn't have to own everything themselves. They were willing to move the asset and let all that growth go to future generations. Now imagine that $13,000 is invested in something today, and for 30 years it just compounds and continues to grow. All that appreciation beyond the $13,000 passes to the children, but it doesn't have to pass through the Romney estate. And here's the critical aspect of it, is that they're willing to let go, willing to do the planning early, before the asset explodes in value, before the investment grows. And typically these investment partnerships lock up for about 5-10 years, say. They're letting the investment be valued early in time, before it flowers, before it develops. So it's a perfect time for gifting. So they've not only adopted a plan in '95, but they adhered to it through a period of years. This is why, by some estimates, their dynasty trust could be worth upwards of $100 million.
Wow. Would you mind elaborating a little bit more on what a dynasty trust is?
A dynasty trust is simply a trust that is designed to hold property through several generations. Assume for a moment you have a parent, child, grandchild. At each step of the way, the estate tax would kick in, and there would be one bite, if you will, one assessment of tax at the passing of property between generations. Here, a dynasty trust takes it out of the estate tax system. So instead of having maybe 4 or 5 transfers over 4 or 5 generations, we only have one. And then by leaving those assets there, we eliminate a tax by creditors, we eliminate possibility of losing assets through divorce and otherwise. So a dynasty trust can also be an asset protection device as well.
I can give you a good example of how powerful a dynasty trust can be. For example, suppose someone like the Romneys put $1 million into this dynasty trust that Jim just described, and let's assume that that a limited partnership interest is then sold to the dynasty trust, and let's assume it's a $6 million asset. And assume again that we take a discount. Jim mentioned that the use of discounts. That is, you can make a gift, and even though it's $6 million, it's not really $6 million because the government generally allows reasonable discounts for lack of marketability and minority interest and other factors. So therefore, it's not $6 million, it might be $4 million, or whatever the discount comes to be. Now, assuming again that we're in a very low interest rate environment, okay, so that the consequences of making gifts have less impact on one's gift tax exemption and federal estate tax exemption. So if $6 million were placed into a dynasty trust and the discounted value was a little over $4 million, and as Jim said, these are placed in trust so they last for multiple generations, okay? And let's assume we go from today and we go out, okay, let's New Jersey's perpetuity statute is what, 90 years, okay? So let's assume we go out 90 years. That $6 million gift, which was discounted to $4.2 million, which would not create a tax currently because the exemption is $5 million, would be worth $91 million at the end of the perpetuity date. So it's a very powerful way of leveraging your gift. And remember now, none of the money in this trust is ever subject to gift tax or estate tax.
That's incredible. Would you explain what a grantor trust is?
Jim?
Grantor trust, to understand tax, you really have to understand history because laws are enacted in response to certain problems perceived by Congress. Grantor trusts began in 1924 and were subsequently modified through the years. They began in an era when the trust tax rates were much, much lower than the individual rates. So it doesn't take much imagination to know that individuals were throwing money in trust, saying it didn't belong to them, it should be taxed at the lower rates. The government responded by simply saying, if you have certain controls over these trusts, certain powers, we're going to tax you on the income. And that worked fine for many, many years. And then after Reagan and other changes came, the tax rates changed. Now the trust rates are higher than those for individuals. But we found another use for that tool. What happens now is that because of the law, this history that began in the 20s, we are responsible to pay the income tax on any money earned by a grantor trust.
That is, the grantor is responsible for paying the tax.
So think about it. Now the Romneys or some wealthy family is there. If the Romneys created a grantor trust and must pay the income tax, they're reducing the size of their estate. What happens to the trust? The trust is not reduced by that payment. That money stays in there, and it's not an additional gift. So in effect, what you wind up doing is increasing the size of the exclusion, currently at 5.12 million. Every year, you could be making this additional gift and it would not reduce your exclusion. So indirectly, you're basically accelerating the growth in these dynasty trusts by using this technique. Relatively straightforward and simple to do if you plan properly early on. And one of the things that we think is, and if you see in the presidential proposals, they're thinking about possibly eliminating this because they have no device with which to counter. So tax is really an ebb and flow, but here's right now is a great opportunity for people if they want to make these types of gifts.
As a further illustration of the grantor trust ability to pass wealth efficiently, we can talk about a grantor retained annuity trust, sometimes known as a GRAT. Okay. Now you know what an annuity is, where you might make an investment and each year you get paid a certain amount. Okay, commercial annuities, people buy them all the time. Well, in the estate planning arena, we create these grantor annuity trusts quite frequently, and especially today in this low interest rate environment where the annuity simply has to pay whatever is known as the applicable federal rate amount is. It's an acronym. It's a requirement of the statute. And currently that rate this month is 1%. Next month, 1.2%. That's all the annuity has to be paid. Now think of how powerful that factor is. Well, if one were to take $1 million and put it into this grantor retained annuity trust, and let's assume, again, we take a discount. We talked about discounts earlier. And let's assume we discount by 25%. So now the amount that reduces the exemption is $750,000. You have $1 million in trust. And let's assume instead of 1%, we give the grantor 2%. And let's assume that the investment, because the investment is going to be made in a high yield investment, such as the kinds of investment that Bain Capital has, and returns 10% a year. And let's assume that that also is a 10-year GRAT. The annuity is going to last for 10 years. Well, all of the income that is generated from that grantor retained annuity trust is taxed to the grantor. The grantor pays the tax on it. And as Jim says, it's as though it's an additional gift to the trust. And then at the end of the trust, how much do you think is going to be left in the trust for the beneficiaries out of that $1 million over 10 years?
Let's hear it.
Almost $3.4 million.
Wow.
So it's one of the things I think the Romneys probably didn't get enough credit for is using these techniques in combination. It's not just one thing that you see in there, but you see several things. And obviously there was much planning that went in there, but also their willingness to stay the course and actually undertake these things and use these as opportunities as time went on. You know, you can try for one shot making a large gift, but in combination, you wind up going to transfer more wealth using the combination of all these techniques.
That's what it sounds like.
When I was in the LLM program a long time ago in a place far, far away, my professor, and it stuck with me until then, said, good tax planning is a lot of small bites. And that's what the Romneys did, a lot of small bites. Now, they're not so small, but they they produced significant beneficial consequences. The IRA, for example. The IRA came into existence in 1974. At that time, I believe you could have put away $1,000 or $1,500, a very small amount. Okay, so the Romneys started their IRA, and they put in 1,000. Then it went maybe to 2,000 and a couple thousand more. But they put into their IRA not $1,000 of cash or a tangible asset worth $1,000. They put into their IRA investments that they knew would grow, that they knew would explode, as Jim used the word. And so over the years, they continued to put into their IRA investment opportunities that would yield high results. For example, many of the Bain investment vehicles had two classes of stock. They had an A stock and an L stock. The L stock was the portion which was the investment portion, where the investors likely would get a return and would get a nice return. The A stock was the speculative portion, which only after the L stock was paid in full and received their investments would the A stock be paid. So the Romneys would take their A stock, which could be valued very low because it's very speculative, who knows if you'll ever get anything out of it, and therefore even in the case of an IRA, where the amount that you would put in is not much, you can take a portion of the Bain investment, value it very low, put it into the IRA, and let it sit. What happens 30 years later? Well, the report is their IRA is worth as low as $20 million or as high as $100 million. So again, the time that one has to invest, the type of investment, and the vehicle all play an important role in growing one's wealth.
Wow. So what are the benefits of IRAs, Roth IRAs, pension plans?
Well, just in Romney's case alone, let's assume he has $100 million currently in his IRA. The current tax rate is 35%. We know, well, we don't know, but we believe income tax rates will be going up. And IRAs money, when you take it out, is taxable. But Roth IRA money is post-tax, so therefore when you pull it out, it's not subject to tax. And so, not that I want to give Romney any advice, because he seemed to have had quite a bit of good advice, but my suggestion would be he should roll over his IRA into a Roth, pay the tax. He probably has enough money to pay the tax at 35%, while it's still cheap, and then roll it into a Roth, and then have the Roth go for multiple generations. It'll never pay income tax. It'll keep growing and growing and growing. That would be my advice.
Great advice.
Yes. One of the things that people sometimes object to when we tell them that they should transfer assets, they don't understand how they can be managed. Here in a Bain Capital Fund, it was pretty straightforward. The fund is established, they have professional managers. You're transferring paper interest. But the average person can do that with a limited liability company. You're not transferring physical deed to a real property. You're not transferring ownership of the underlying security. You can still have your portfolio manager manage that property. And what you do by aggregating these assets and then giving out the paper interest, the intangible interests which indicate ownership, is you allow them to participate in growth with professional managers. Now we all know fees will eat into financial assets, but if you're aggregating the assets, you're only paying the fee on the larger pot of money, so to speak. What that does is you can give away to the younger people in the family, children, grandchildren, and so on, without really disturbing your investment portfolio. So it's a much more efficient way of transferring wealth than just simply handing a check. Because once you hand the check to somebody, they in turn have to go out and invest it. Now obviously Bain is an exception to the investment opportunities, but here you can maintain the asset base that you have, be it financial assets, be it real estate or otherwise. You can maintain that continuity of management and business purpose, and yet allow them to share in the growth. So in the Roth sense that Frank just described, these opportunities were moved over at a time when their values were depressed or speculative, yet they flower and explode into substantial wealth.
And continuing on with the discussion about IRAs, one point that I think people should realize, and of course it depends on what state you're in. New Jersey is favorable. IRAs are, and pension assets, be it 401ks and 403bs and the like, are protected assets from creditors. Not only can these vehicles be used to develop your wealth, but they also can be used to protect your wealth. And so I encourage all my clients to max out their pension contributions or IRA contributions, because then their nest egg will be really large, number one. And number two, it'll be protected from creditor claims. And going back to the dynasty trust, which we talked about earlier, Jim discussing LLC interest and the like going into dynasty trusts, trusts are the most formidable vehicles for protecting assets. If they're drafted properly, they're nearly, I want to say absolutely, but they're nearly impregnable. And so part of wealth building is wealth preservation. We don't, you want to build it and make it, but you also want to preserve it. So what we do is not only create the vehicles to increase your wealth, but we also create the vehicles to sustain your wealth, protect your wealth.
Thank you so much. You guys are both extremely knowledgeable, and I know that I found this really helpful. Thank you so much.
Thank you for having us.
You're welcome. If you have any questions, please feel free to contact these gentlemen and visit their blog at taxtrustestatenews.com. I'm Nicole. Thanks again for watching.